let's start from the foundation because this is the single theme that threads throughout everything in individual taxation. Alrighty, so gross income is extremely broad. The Internal Revenue Code basically starts with all income that is taxable, unless a specific law tells you otherwise. Okay, so mentally, never start with, is this taxable? Start with, it is taxable unless something in the law excludes it. Okay, so if it adds to your wealth, if it increases what you have available to spend, or it gives you an economic benefit, the IRS almost always considers that income. Now, if we take a look at some common examples of wage categories, you'll notice that while yes, wages will always be included in gross income, you need to also note that wages is not just a paycheck that you get direct deposited. Income can be constructively received. So what does that mean? It means that you had access to it even if you didn't physically have it yet. So if your employer tried to pay you, but you simply weren't available to receive the check, that's still going to count. All right, so other forms of wages. Property compensation also counts, and this is going to be the fair market value as your measurement. All right, bargain purchases. Think a partner discount or buying something below fair market value because of your employment. That excess discount is taxable wage income. Guaranteed. What's going on? My name is Joey, and I'm the founder of Universal CPA Review. You're probably here because you're ready to pass the CPA exams once and for all so that you can advance in your career and move on with your life. Let me be the first to tell you that I've been there and I feel your pain. But I'm also here to tell you that the CPA exam doesn't have to feel like such a maze, and there is a path to a passing score. So what are you waiting for? Don't waste any more time. Commit to the process because it will pay off. In my opinion, I say let's knock out the CPA exams once and for all. Guaranteed payments. So this is very similar to receiving a W-2, but we're thinking about partners within a partnership. So partners that get paid no matter what is going to be considered ordinary income. And services. Bartering counts. If a plumber fixes your sink and you do their tax return in exchange, both parties have taxable income based on the fair market value of services received. All right, so the key mental model here is that if money, goods, services, value, or benefit comes your way and you get to keep it, then the IRS will generally want a piece. All right, so for example, if Linda Larper found $4,000 under her floor bed and kept it, that's taxable even though she didn't earn it, because she still received value that increased her wealth. So now that we know gross income is broad, the next step is, how do we measure the amount of income? The rule is extremely simple. Income is measured based on the value of what you receive. If it's cash, obviously that's the amount of cash received. If it's property, you measure it at fair market value, not what you think it's worth. It's what the marketplace says it's worth. All right, so if it's services, same thing. You pick the fair market value of services. This is going to be huge on your exam. A lot of multiple choice questions will purposely try to trick you into thinking that property barters are not income. They absolutely are. All right, so now thinking about the difference between taxable events and non-taxable events. If it's a taxable event, you're going to recognize income at fair market value, and your basis in it becomes the fair market value. If it's a non-taxable event, you're going to recognize no income, and your basis is going to carry over at the net book value. All right, so you must internalize the phrase GAAP versus tax because it shows up everywhere. All right, so GAAP uses fair value terminology. Tax uses fair market value. So when in doubt, tax is going to use fair market value. All right, so that's just a little nuance, but something to keep in mind. All right, so the bottom line is that if you receive something of value, whether it's cash, a car, free rent, free design work from a friend, the IRS is going to treat it like money. All right, so now let's think about non-cash income. All right, so Linda is going to perform graphic design services, and instead of cash, she gets paid with a new laptop that's worth $2,000. Right, so there's no cash involved here, but she did receive value. The laptop has a fair market value of $2,000. So that is taxable to Linda. Right, so this is extremely commonly tested. They love services for property barter type scenarios because a lot of students freeze and think, well, there wasn't cash, so maybe it's not income. That is wrong. All right, so services in exchange for goods when services in exchange for services or goods exchanged for services, these are all going to be taxable events based on fair market value of what was received. All right, so if you get paid in goods or perks instead of cash, the IRS still treats it like income. All right, so now we're talking about the difference between realization versus recognition. This is a top exam tested conceptual distinction. All right, so realization is something that economically happens. You receive something of value, or you sell or exchange an asset. Whereas recognition is saying that you actually report it on your tax return. All right, so think of realization as when the economic benefit occurs, whereas recognition is when the IRS requires you to record it. All right, so rec for recognition equals rec for record it. All right, so certain situations are realized but not recognized immediately because the tax code gives exceptions or deferrals. Things like Section 1031, 121 home gain exclusions, involuntary conversions, etc., etc. And we're going to get to more of those in detail later. But 90% of the time in exam questions, realized gain will equal recognized gain. All right, so the key takeaway area is extremely important here. For tax purposes, the cash method is used for individuals. So what does that mean? It means that income is recognized when actually or constructively received. So you receive the cash or you constructively receive the cash, it's going to be recognized for tax purposes. Okay, so quickly taking a look at an example, we're saying here that Linda buys stock for $100. It increases to $150, but she has not sold it yet. Right now, she has not realized a gain. It's only paper growth, right? Paper growth is ignored until you sell or exchange it. So once she goes ahead and sells the stock for $150, then she has a realized gain and a recognized gain of $50. All right, so think about this. Value increases don't trigger tax. You must have a realization event, typically a sale or exchange. All right, so I know that can be a little bit confusing, but basically what we're saying is just because it's a realized gain doesn't mean that it is recognized, aka recorded on the tax return. But if it's a recognized gain, it will always have a realized gain with it. All right, we must first realize it to recognize it. All right, so thinking about the timing of revenue recognition, aka accrual versus cash. All right, so accrual is a method where income is recognized when earned. So for those of you who've taken the FAR exam or plan on sitting for the FAR exam, that's talking more about financial reporting standards. All right, so that's going to be GAAP focused. Timing is going to be tied to when the performance obligation occurs. When you're thinking about the REG exam or even the TCP exam, the cash method must be associated with tax. And that's saying that income is recognized when received. All right, so when cash is received, any other form of income is received, that is going to be recognized for tax purposes. All right, so that's the tax method for individuals. All right, so the exam loves to test the comparison of receiving something in December versus January. All right, so this is something that constantly shows up in multiple choice questions. All right, so under the accrual method, if the invoice is sent in December, it's going to be taxable in December. Okay, so in other words, on the financial statements, we're recording the tax liability in that December month because it's when the performance obligation occurred. Because income is recognized when earned under the accrual method as GAAP rules. But for tax purposes, we're going to narrow our focus on the cash method. And that's when income is recognized when received, whether that's cash or property at its fair market value. All right, so as an example, if it is paid in January, then it's going to be taxable in January. Alrighty, so if the invoice was sent in December and paid in January, and the question's asking how much is recognized as taxable gross income in this subsequent year, it will be included because January was the month that it was paid.